Well, it was a slightly more subdued week for the financial markets last week, which felt a little bit like the calm before the storm. Equities a touch lower, the S&P 500 selling off for a first week in 6, while Treasury yields rose slightly, particularly at the long end of the curve as the FX market stayed relatively range-bound. A much busier week awaits the financial markets this week, with a big risk event coming up almost every day over the next 4 or 5 trading days. The calendar highlighted by Thursday's ECB decision, with Lagarde & Co. likely to deliver the first rate cut of the cycle, as well as, of course, the headline non-farm payrolls number and the rest of the US labour market report coming out on Friday lunchtime. Plenty for us to discuss on the Trade-Off UK, as always. Without further ado, let's crack on with the show. So before we get into the show and bring Ryan into proceedings, something a little bit different, we are launching a new version of the Trade-Off here at Pepperstone, the Trade-Off China. And I spoke last week with our China strategist, Dylan Wu, all about the show. So in a moment, you will see that interview and my outfit will magically change. And she will tell you all about what's coming up when that show launches on the 6th of June. Right, Dylan, our China strategist from down in Melbourne, joins me. Dylan, how are you doing today?
I'm good. Thank you, Michael. Thanks for having me today. How are you?
No, all good, thanks. Absolute pleasure. So Trade-Off China launches on the 6th of June. Very exciting indeed. What are you going to be covering in the show?
Actually, ideally, I want this show to be have a very global perspective, but with some local specialties as well. So firstly, I will cover something about, Fed rate cuts, G10 central bank policies, and probably US equities, basically anything and everything you can think of. And secondly, I will also cover gold, Hong Kong 50, CN50, and yen, to name a few, to better serve the local interests in APAC and China. So in the last part of this show, I would like to cover some interesting strategies or some niche assets like, orange juice, copper, something like that, to give people a feeling of opening a blind box every time. So it's like I really want to make something interesting, inspiring, and want people to enjoy this show.
Good stuff. Sounds very good indeed. I mean, Ryan and I are already got a little bit of competition with Blake and Westy, but sounds like we're going to be looking over our shoulder even more with this latest iteration of the trade-off that we're going to be producing. In terms of Chinese markets, I mean, it's obviously an interesting time. It's been a pretty brutal couple of years for the China and Hong Kong equity space, but signs of a recovery starting to emerge. I mean, how are you viewing the landscape at the moment?
Yeah, I mean, China's market is quite interesting at the moment. I agree with you. And as we can see, China just keep making some, proactive attempts to save their economy, including the issuance of 1 trillion yuan special bond, and also, rate lending program to save the market. So I feel really excited about seeing what will happen along the way for China to boost their market. So if you want to know more, please enjoy my show.
Indeed, yes. I won't ask you for any more spoilers, but it is the perfect moment to be launching the Trade-Off China, which goes live on the 6th of June. We'll have a link to the first episode and to the YouTube channel in the description below. Dylan, thank you very much for joining me to run us through, I should say, your exciting new show. And in the meantime, let's get back to myself and Ryan with the Trade-Off UK. Okay, so Trade-Off China launching on Thursday. Back in the here and now, let's bring Ryan Littlestone into the show from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. How are you doing on this fine spring Monday?
Fine spring Monday. We're not in summer yet. Don't tell me it's still spring.
Are we?
I'm going to go back to bed and hibernate for another couple of weeks. But I'm doing well, mate. I'm doing very well. Thank you very much. And I want to say well done to you. And, last week's show, you nailed the top in cable and pretty much got your dip in the FTSE as well for a good few hundred pips. So, you're doing very well, mate. Good calls.
Well, thank you very much indeed. Right back at you on that one. I think we're both giving each other metaphorical pats on the back this week. It's nice to know that, just sometimes we do know what we're talking about on the show.
Yeah, now and again. I've got to say, it happens more often than not. We should say that. Probably better, more of a record than those guys across the pond there, the Mr. Westy and Mr. Blake.
Oh,
so
undoubtedly.
we'll have to compare records at some point.
Yeah, I'm sure we will. I think we could have a little charity wager on that towards Christmas time, or maybe even a lunch if one of them decides to make their way over to London and buy it for us. In any case, we can sort that out later in the year. We've got an incredibly busy trading week ahead. So let's get into Topical Thunder and break down everything that's going on this week. So we are heavily leaning towards previewing the week ahead, actually, in this segment, and that's pretty much because last week was almost like watching paint dry when it comes to the price action for most of the time. So let's crack on. I want to talk about the ECB, first of all, because I think the ECB meeting, and I feel ill almost saying this, has become a lot more interesting than it was if you'd have asked me this time last week, and that's by virtue of the inflation figures that we got out of the Eurozone on Friday. Headline CPI ticking up to 2.6 from 2.4% previously. And even more worryingly than that, the core number ticking higher to 2.9% for a prior 2.7%. And Ryan, you've mentioned a number of times now that 3% seems to be this kind of line in the sand below which central bankers are happy to endorse the idea of cuts. Well, core inflation in the Eurozone is dangerously close to going back above that barrier as we move into the rest of the summer. Now, in terms of Thursday's meeting, a 25 basis point cut to the deposit rate is absolutely nailed on. They've been communicating that since all the way back in March, and it would be a huge surprise if Lagarde and co. did not cut the deposit rate to 3.75% at the conclusion of the June policy meeting. But I think the bigger question for me is over how they frame that rate cut. What guidance comes along with that? Now, I think there's probably two ways that they can play things. I'm keen to get your thoughts on this in a second, Ryan. You can either, and this was my base case back before those inflation figures, where you frame this rate cut as the first in a series of cuts as they normalise policy and move rates back towards a neutral level, obviously maintaining that data dependency, but signalling quite firmly that more cuts are coming at a relatively regular pace. Or, and I think I'm sort of starting to lean towards this scenario now, you almost frame it as not necessarily a one and done move, but a reversal of that insurance hike that was delivered in September last year. That was delivered almost to say, we think we've won the battle against inflation, but we just want to do one more in order to make sure we actually have. You then frame the cut as saying, we think we can normalise policy, but we're not quite sure yet. So let's take the very first tentative step and then wait a while and see what happens next. And I think the latter scenario is becoming an increasing risk after that inflation data, and particularly as downside risks to the Eurozone economy become or continue to diminish. I mean, unemployment hit a fresh record low in April, according to data last week. So I think actually the risk is a relatively significant one now that we're actually looking at just 2 ECB cuts this year and a much slower pace of easing than we'd perhaps previously been expecting. But as I said, can you get your thoughts on that as well, mate?
Yeah, I think you're right with that. And the inflation data last week, I think, is pretty much knocked a July cut on the head. So I don't think we'll be getting a quick cut one after the other. And, I think, as we know, they like to leave their monetary policy move to those quarterly meetings where they get their new projections, because that's what they base their decisions on. So we're perhaps going to have a bit of a bum fight between the hawks and the doves. Some of the hawks, looking at most 2 cuts. But then, some of the doves, we're really only talking 3 cuts from the majority of them. So we're not arguing about too much whether it's 1 or 2. But I think that they're going to take the cautious approach. They're always going to be balanced about it and talking about the risks to their outlook. There's always risks depending on what side of the fence they want to play them on. And I think that's going to be the case that we get from Lagarde this week. They're going to cut. They've been prompting that long enough. And the forward guidance will be important, but I don't think there's many that now see a July cut coming. And we're probably going to see if we get one September or December. So there's really only 2 times that they can really choose to cut again.
Yeah, I think you're right. I think it's a question of, is it September, is it December, or is it both at this point? We can debate the merits of basing monetary policy on forecasts that are inevitably going to be incorrect, but we certainly don't have time for that now. What we do have time for is, if you think about the G10 universe, we are really getting into that summer of rate cuts now. The Swiss National Bank obviously have already gone. The Riksbank have already gone. The ECB, as we discussed, are going to go on Thursday. Are the Bank of Canada going to beat them to it on Wednesday afternoon with a rate cut of their own?
That's the question indeed. They're stepping up to the Oki on Wednesday to deliver their latest monetary policy ramblings. But the talks on cuts have been rather loose from those guys. There's been no firm commitment until inflation is sustainably coming down. And inflation has been falling, but at their April meeting, they said the council will be looking for evidence that the downward momentum is sustained. At the start of May, Macklem came out saying that they're getting closer to cuts. Well, they might now have that further confidence on that sustainability because CPI has come down in the last numbers. The latest data, the headline CPI fell to 2.7% from 2.9%, and the BOC core measure dropped to 1.6% from 2% prior. That's a pretty steep drop. We talk about the 3% being the pivot level. Well, the 2% is their target for a lot of central banks. So we got that well below that. So that core measure dropping is quite significant. I think that, alongside all the other 200 measures that they like to use to guess inflation, might be enough to push them very close to a hike. Whether that's at this meeting or not. Sorry, a cut. Sorry, got a hike on the brain at the moment.
I'm glad I'm paying attention.
Yeah, I'm glad you are as well. It's Monday. So yeah, it pushes them very close to a cut. And as I say, whether that's this meeting or not is going to be the question. Now, market expectations are pretty high, and it jumped since last week's data up to 80% that they cut at this meeting by 25 pips, which means that the bigger price risk for this one is if they don't cut. At the very least, if they don't cut, I think they will use the buzzword and indicate that they've gained that greater confidence on inflation, but with the obvious upside risks that are always in play. For me, I'm a little bit more on the fence. I'm about 50-50 on whether they cut at this meeting. It seems like the market's really ramped up those expectations pretty quickly over the last couple of data points, and maybe a bit too far, too fast. But obviously this meeting is going to be very important for the Canadian dollar, and I think you have to take forward what happens here as the potentially overriding theme through the rest of the week. For example, if they are particularly dovish, bear that in mind when assessing price moves over future data points that may take the loonie in the opposite direction, as those sort of moves may not last.
Yes, indeed. I think that's a brilliant summary of that, apart from your Freudian slip around rate hikes there. It was almost like Dick Matthews had entered the room. No, but more seriously, I think the BOC meeting is going to be an interesting one this week. I'm leaning towards them delivering that rate cut. I think there's probably enough evidence there for them to do so, particularly on the labour market side of things. Things do seem to be weakening off pretty rapidly, albeit with the caveat that we get the May jobs report on Friday, which comes after the next BOC decision. I think it's also interesting that we're probably going to see a fairly significant divergence between the Bank of Canada and the Fed. I mean, that's not unheard of. They don't necessarily move in lockstep, but they tend to be tied pretty closely in terms of their policy moves. So that's going to be a relatively interesting one. And I think the point you made right at the end there around viewing the rest of the week's move in the moves, I should say, in the context of what the BOC are doing is an important one, particularly if you look at implied volatility. I tweeted this out earlier on today, Monday morning, by the time you see this. And actually, the only place in G10FX this week where we've seen a really notable pickup in implied vol is in dollar CAD, where I think options price a move of roughly a big figure either side with one standard deviation of confidence. So on that alone, you would actually say, in terms of pure volatility and risk that the market prices, the BOC is the big one.
Yeah, very much so. And as you say, whatever happens at the meeting gets put to the test on Friday when we get to the latest Canadian jobs numbers. So if they're pretty bullish the economy and we get a stinker of a report on Friday, then that's going to change those expectations for any future cuts, if they've cut on Wednesday, that is.
Yes, absolutely. But I do have to be honest, I'm not going to be paying any attention whatsoever to the Canadian jobs data on Friday, because we have something much more important at exactly the same time, and that is the non-farm payroll figure and the rest of the US labour market report, which is also out at 1:30 on Friday. Now, we're expecting headline non-farm payrolls to have risen by around 190,000 compared to a prior 175, although that will undoubtedly be revised at some point over the next couple of months. No, I'm not going to give you my guess US now before Ryan asks. The leading indicators for the jobs report, well, they're a little bit thin on the ground at the moment because we don't get the manufacturing PMI, the ISM report, until, well, around 40 minutes time. So it will be out by the time you watch this video. And then we get the services print on Wednesday afternoon. Initial claims, they were pretty much unchanged between the two survey weeks. Continuing claims a touch higher, but I don't think that's anything particularly worth worrying about. Now, of course, 190,000 would still be a pretty solid pace of jobs creation, but it would also be one that's consistent with a labour market that continues to slow down, and it will be below what we would call the break-even pace of jobs growth, which is somewhere between 220 and 250-ish thousand a month, and that's the pace of job creation that's required to keep up with growth in the labour force. So clearly some signs of slack beginning to emerge, at least at a headline level in terms of job creation and payrolls growth. But elsewhere, the report should be pretty solid. Average hourly earnings expected to rise around 1/3 on a monthly basis, which is, I think, where average hourly earnings have been for the vast majority of the cycle, at least over the last 12 months or so. The yearly pace is seen unchanged at just shy of 4%. Unemployment also seen at just shy of 4% at 3.9. That is as near as makes no difference full employment. I don't think anyone can complain too much about that. And participation should say just let me start that again. Participation should stay just shy of the cycle high at 62.7%. That is very, very easy for me to say, as you can tell. I think it's important also to just contextualize the jobs report in light of what the Fed have been saying recently. The inflation side of the dual mandate, in my book, still takes precedence in terms of the timing of that first rate cut. The Fed's guidance has been very clear that they're looking for confidence inflation is moving back towards 2% before they do deliver that cut. And they're not going to overreact to one jobs report, whether it's particularly hot or particularly cold. And actually, Chair Powell helpfully outlined at the last FOMC press conference that it would be an unexpected or a significant weakening in the labour market that would elicit a policy response rather than a relatively gradual one. And as he also said at that press conference, a couple of tenths worth of a percent rise in unemployment would not meet those conditions. So I think the US jobs report could be good for some intraday volatility on Friday, a bit of a knee-jerk move. But for me, it is next Wednesday, the 12th of June, that is really the key one in terms of event risk in the United States, because not only is that the next FOMC decision, but that is also when we get the next CPI print, which is obviously going to be very, very important indeed. So, Ryan, what are your thoughts ahead of payrolls Friday?
Yeah, I think you're absolutely right. We have to see a real bad number, or a real big heavy miss. Unemployment jumping up to 4.5% or something like that to really get the market moving. But the market is still in a mood where it wants to sell dollars on any sort of bad news. And we had that the last NFP. We got that jump in unemployment. It wasn't huge, but it was enough to get the market panicking and running around with its hair on fire. And I think we'd probably get the same again if we get a miss, if we get 150k or 100k NFP. The market's going to throw a bit of a wobbly about it. So, yeah, you have to look at it in the context. Does this mean, something like that? Does it mean that the jobs market is collapsing? Yeah, if we get unemployment 4.5%, obviously. But if it's just another pit move here and there, the market may, throw its toys out the pram. But I don't think the bigger picture is going to change. None of the Fed members have said that they're worried about anything. And as you say, at the next time we get the projections at the FOMC, we'd like to see the dots changing again and less cuts forecast for the year. So, yeah, I think this is one where you've got to trade the intraday volatility surrounding it, the first half an hour, then read everything in the bigger picture. And one of my focus points will be that wage number, because it has been sticking to around that 4% mark. Again, it did drop last month, but it's still looking sticky. So even if we get a good number, watch that number. If it does have a significant fall there, then that's going to get the cutters all raring to go.
Yeah, agreed. And of course, relatively elevated earnings growth is one of the things that's likely keeping services prices relatively high. And that is the main point that is keeping core inflation relatively stubborn at those elevated levels. And that's common, not just in the US, but really on a global level. I must say there's no danger of you running around with your hair on fire, even if the market might be doing that at some point on Friday.
Maybe my beard will catch a light. He's got too much vodka spilt in it and I walk past with a fag. But yeah, as for the rest of it, yeah, that went a long time ago, mate.
Indeed. Right. Well, we've done the ECB, we've done the BOC, we've done payrolls. What else is going on this week?
Yeah, lots and lots this week, and hopefully gives us some good trading volatility. Obviously, we covered the two central banks in the NFP. Now, as we film this, we've had out the manufacturing PMIs from around the world, which have seen some further small improvements, and we'll wait, as said, the ISM number coming later today. Tuesday, we get Swiss CPI, which is obviously going to be important, as you said, for the SNB meeting, because that comes later this month as well. Then in the US, we get the latest JOLTS numbers, which, although it lags by about a month, the market likes to look at that one just to see whether things are tightening or loosening up there. Now, Wednesday, there's an important data point out from Japan. We get some wages and earnings number for April. So this may give us the first look at all those wage deals that we've spoken about previously. They've all happened, and now we'll see whether they're going to filter through to the broader labour market. We also have the NFP aperitif by the ADP numbers, which I know you love those, Michael. And then the final services PMIs from around the world again, and then that culminates in the ISM number in the US. Then on Thursday, we do get Eurozone retail sales. Well, obviously the ECB will be the bigger picture, but that might just be a bit of icing on the cake for expectations of cuts past this June meeting. And then one data point I look at, challenger layoffs in the US, will give us again some further insight into that jobs market. And I'll be watching those to see if they've picked up further. We've had a few hefty numbers recently, so that's going to indicate maybe some problems emerging in the labour market as well. Then on Friday, the NFP, and as mentioned, we got the Canadian jobs too. And as said, that could be a big first test for whatever message the BOC puts out on Wednesday.
Yeah, absolutely. I think it's really one of those weeks where there is something for everyone, and it makes you kind of question how much noise are we going to get and what signal are we going to get, if any, out the back of that. I think I was talking to some colleagues earlier on and saying, it could be one of those weeks where there's a lot of intraday volatility, but we perhaps almost end the week exactly where we started it because everything ends up netting off against each other. So, I think that's important from a risk management perspective, being aware of the chunky slate of event risk that we've got going on. And of course, I think the other question is ADP. What the hell is the point?
Well, it just gives everyone a little bit of a taster, doesn't it? If it's a big miss or a big beat, then the market likes to extrapolate that for the NFP, and if it's in line, everyone goes bothered and moves on. But it's data; it can move markets. We have to pay attention to it.
True. I mean, I think I'd rather predict non-farm payrolls using lunar cycles at this point than using the ADP print. But then, having said that, looking at the track record of my sweepstake guesses recently, I think maybe the lunar cycle might be something I need to turn to at this point.
Oh, well, I didn't want to say anything, but you might want to, or at least check your tea leaves.
I just wanted to get that dig in myself before you did, because I knew that's exactly where you were going. Right, let's move on and get into some charts if that's the setup. Right, no lunar cycles, tea leaves or Elliott waves going on here. We're going to get into some charts though, and I want to kick things off. If you've got an Elliott wave on your chart, I'm going to regret saying that. I want to kick things off with gold this week. I think downside risks are starting to grow for the yellow metal. I mean, we broadly remain in this 2,300 to 2,400-ish dollars an ounce range that we've been in pretty much since the middle of April, maybe the start of April now. But I think it's interesting to note that on Friday, spot gold, this is, closed below the 50-day moving average. And that's the first time we've closed below that mythical pink line since all the way back at the tail end of February. And that comes, of course, in a week where Treasuries sold off relatively aggressively, particularly at the longer end of the curve. We had some pretty poor auctions last week, which I think raised some concerns about how the market is going to soak up all this issuance that we're getting. And the curve also steepened pretty aggressively last week too. And I think perhaps this is just a sign that some of the more traditional drivers of gold are maybe starting to reassert themselves, something that I know both of us have been flagging for some time now. Gold perhaps moving from being this momentum juggernaut to maybe coming back to the macro trade that it tends to be. Now, I think the bears are likely to be feeling relatively good about things at the moment, but certainly further emboldened if we do get a close below either $2,300 an ounce, the big figure, or below the April lows, which come in around 22.75, because below that there's really nothing in terms of support until the 100-day moving average, which is around $75 below that. Such was the speed of the move higher that we saw. There really isn't a lot in terms of downside levels. So I think gold could be on relatively shaky ground, and if we get certainly among those PMI prints, if we get some relatively hot prices paid measures, then maybe the bears are going to have a little bit more fun with the yellow metal.
Yeah, this is definitely one for the range traders. We've had a go at breaking out the 2400 level, got above those prior spike highs, which came about over Iran news headlines, a bit of risk off. But we couldn't hold the move higher, and now we're back in the range again. And likewise, down below, 2300 is pretty important. We do have had that little extension, as you show in your chart there. So yeah, I think it's strange because it's had such a strong move, and now we're in this what do we do now mode. That does give range traders something to lean on. It's going to be interesting if we do get a move back to 2400. Is that going to hold, or even if we just break a new high, get above that 2450 area, that's going to suggest that the market's still ready to take this one higher. But then again, if it fails there, then we're going to get a move back to 2300. And like you say, again, 2300 is a big level. If we break under there, it's got to make a new lower than that prior one, or else we're just going to sit back in the range. So I think for this one, you can trade the middle, but then look to go with the breaks if they're confirmed.
Okay, Ryan, what about dollar CAD? We spoke about the BOC, so how's the currency looking?
Yeah, might as well look at this one as we've got the BOC coming up. This one could be another wild horse with a ton of big US data, and obviously the BOC meeting. We've been ranging quite nicely between 135.90 and 136 and up to the high 137s, but we're sailing close to the lower end coming into this week. So for one thing, you'll note that the oil correlation is switched off right now. We saw WTI dumping nearly $4 after tapping that 80.50 level we had on the show last week. And all the time we saw the Canadian dollar strengthening in this pair. So that shows you what side is really doing the driving last week, and it really wasn't the Canadian dollar. So as I mentioned on the BOC topic about keeping what happens there at the back of your mind for trading after the meeting, but this is one pair where the US dollar may have a bigger influence. Thus, if we see some weak data from the US, the bottom of this range is going to be tested, and we might even get a break. Excuse me. So the trade I'll be looking for from this one, we'll be looking if we get some weak US data, putting pressure on this pair. Then I think that if the BOC come out with a bit of a dovish, meeting announcement, which leads to a quick sell-off in dollar CAD, I'll be looking to counter that trade. So if we see a move higher in dollar CAD, then I'll be looking to fade that move. Now, if that 135.90, 136 area breaks, I think we could see a quick move down to the 135 level. So there's a possible break trade to look at as well, but I'll be less keen to trade that ahead of the BOC. On the other side, good US data and a dovish BOC could see the support holding and then testing the top of the range. Now, while I have one definitive plan for shorts, I won't be closed-minded to any opportunities on the other way, and that's if the data and the market tell me to do so.
Yes, indeed. I don't have too much to add here. I think we spoke at length about the BOC and the Canadian dollar earlier on. I've already made that point around implied volatility. But I think this is another one which really just represents the relatively range-bound and nature of the G10FX market. We have those well-defined levels. It's a question of waiting and seeing which of either breaks and then reacting to that as and when it happens, or if it doesn't break, of course, reacting to if the market holds on to those levels. So, yeah, very much a wait and see one here, particularly with all of the various moving parts that we've got this week.
Yeah, very much. I think you nailed it earlier by saying that you're probably going to have to be nimble with a lot of pairs this week, and this one's going to be another one. Just to trade between the data points, but don't get too stuck in heavily into a trade where the next data point or the BOC could upset that.
Yes, indeed. Right, moving on, I want to have a look at the S&P. The first down week in 6 last week for the S&P 500. And actually, it could have been a lot worse if we didn't get a really sizable rally into the market close on Friday. I think there was something like $7 or $8 billion in terms of the market imbalance to the buy side on Friday night into the market close. And of course, that helped to prop things up into the end of May. And as June gets underway, there wasn't really any obvious catalyst for the move lower, perhaps a few people trimming some risk ahead of what is an incredibly busy economic calendar this week, as we are all aware. But I think fundamentally the bull case remains intact. Economic growth is still relatively solid. Earnings growth is still chugging along okay. And of course, you've also got Fed policy support still on its way, albeit perhaps to a lesser extent than we had expected much earlier in the year. And then, of course, from a technical perspective, forgive me, these moving averages continuing to be well respected by the market. If you look back to mid-April, where we saw that chunky move lower, where did we stop? Well, it was the 100-day moving average that held firm. This time around, where have we held firm on the declines last week? Well, it's a 50-day moving average, which comes in around 5,200. And all of the time these levels are remaining firm, it seems that the market is willing to be buying into any weakness and scooping up dips as and when they occur. And that is exactly what I would be happy to do at the moment as well.
Yeah, I think this is going to be a very interesting one to watch this week. You know, let's just say, for example, we get a whole batch of poor US data. Are we going to see stocks rallying to new highs and breaking those highs and carrying on? Or will maybe the market start to think, well, actually, if the economy is starting to turn, is that going to be good enough for firms still to make profits? And is that going to be good enough to stocks? You know, I'm still with the old school where bad news should be bad for stocks, not good news. But we're in a different world at the moment. And I want to see if that continues or not.
Yes, I'm very much in the bad news could be good news if it elicits a more aggressive or a sooner policy response. But again, that's something else that we don't really have time to get into on the show, because we really could talk about that all afternoon. Instead, let's get on to our last chart, which is the euro.
Yep, going to look at the euro again. Obviously, with the ECB coming up, this is going to be an important one to watch, and yet another one caught in the middle of between data and the central bank. And maybe a last chance to see some upside. We've had a few goes at getting up to that 109 level, and in March we did try a break, but it couldn't hold. And what's striking about this pair at the moment is that it seems at odds with both what the Fed and the ECB are doing and their stances. You know, while the Fed is staying higher for longer and the ECB is about to start on their cutting phase, one would think you'd see US strength or US dollar strength and euro weakness, but it's been the opposite for this pair. Now, in my opinion, that's the market telling us that it's well on board with what the ECB is doing, it's thinking, but it's still at odds with what the Fed stance is and its current line and keeping those rates higher for longer. So whatever your thoughts are on where or how this should be trading, it's going to trade where it wants, and we have to respect the price action. So I think there's going to be ample opportunities to trade this one this week. I'll be looking at possible shorts if that 109 level holds through to the end of the week and all is known from data in the central banks. But we're also in a bit of a downtrend, so we really need to break this 109, or we might be taking a walk lower back down towards that 106 area perhaps. On the other side, for longs, I'll be looking at maybe dip buying into 107 or even better, 106 and a half, 106, or getting long on a confirmation break of 109. But I don't think anyone needs to take a real directional bias in this pair this week. Just go with the flow and let the levels do the talking.
Yeah, maybe no directional bias this week, but have we still got our, 105 or 111 bet going on?
We certainly have.
Are you feeling any more confident on that one? Because I although I think that the risks are tilted a little bit more hawkishly for the ECB this week, I do think, you know, if you look in the bigger picture, why would you want to be long the euro over the medium term against the dollar? Looking at policy, looking at yields, looking at growth, there's really still nothing that speaks to me saying, you know, euro dollar needs to be trading 3 or 4 big figures higher than where spot is at the moment.
No, absolutely, and you can. There's lots of context in this chart or in this pair. If you look, you know, obviously the chart you show there, we're in a bit of a downtrend at the moment. You know, it's pretty shallow. If you come out to a weekly chart, you can see over the last 2 years we've done nothing but go sideways. Look at an even longer chart, take into account 2019, 2020. We're at the bottom of a big decline. So yeah, I don't see a reason why things should move a huge amount. And if it does, it's going to be on the back of the dollar. And likely, if the data really starts to crumble, then I think you're going to see 109 blown out and probably 110 not long after. And if that happens, then I'll certainly be feeling a bit more confident than I was when it was moving down to 106.
Of that, I have no doubt. Right, let's get on to our plays of the day. Right, well, Ryan mentioned a moment ago about things moving sideways, and that is exactly what I want to talk about, because the dollar index and the FX market more broadly is not really going anywhere at the moment. This 104 to 106.5 range in the dollar index remains pretty much intact, as it has done for, well, the last 3 months almost now. But in the shorter term, we seem to have formed an even tighter range over the last fortnight or so, with the 100 and the 200-day moving averages at around 104.40 to the downside being very strong support, and the 50-day moving average around 105.10 to the upside, really capping things as relatively strong resistance. So I think in a week that is likely to be relatively heavy on noise and relatively light on signal, playing this range in the short term is what I would be looking to do this week. Obviously buying an upside break, selling a downside break, but looking for the price to remain within these broad 104 to 106.5 boundaries, which obviously become your natural targets on any closing breaks, either above or below those moving averages that I just mentioned. And then if we do happen to close outside one or the other, then we look to reassess things and see where the market stands as what is going to be a very busy week draws to a close. But I think for now, playing the range is probably the way to go. And Ryan, I think you're looking at something similar, but in terms of crude.
Yeah, something fairly similar. I'm looking at the other side of oil this week. Last week, I looked at WTI, and this week I'm going to look at Brent. And this time we're sitting at the lower end of the range. Now, oil still looks weak, even after OPEC Plus and those lot extended their production cuts and saying it will phase out voluntary cuts later this year. Now, one aspect that caught my eye from the OPEC meeting was the Saudi energy minister saying we are waiting for interest rates to come down. So that was quite an interesting comment. They're waiting like the rest of us for something to spark life into the oil market. And they may be getting their wish in part this week. We've got two central banks on the cards, as we know. Now, on the demand front, we're still seeing some improvement in manufacturing, as mentioned about the PMIs today. And if rate cuts do spur that demand, then we could see, the demand side of the oil market increasing, and then that'll be supportive for oil. Suffice to say, I'm looking at for more of a short-term play, long on the support area around 80 for a move back towards the top of the range up at 85. But I'm also pretty keen to reverse that to a short if that 80 level breaks, and then the 61.8 fib and the $80 mark breaks as well. So I'll be looking to play both sides of the coin in this one. Bit of support for a long, and if it breaks, go short.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Plenty for us to discuss, and I think it's going to be a very busy week ahead. If you have enjoyed the show, then please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, and if there's anything you'd like us to discuss in next week's show, because next week is incredibly busy as well. Our market's getting a bit of a baptism of fire to get June underway, but we will indeed be back with another episode of the Trade-Off this time next week. In the meantime, have a very good week ahead, and we will speak to you then. Thanks as always for watching. Goodbye for now.